Hi, my name is Nathalie Molina Niño. I live in New York. I am a full-time investor and a recovering technology startup founder. My book is called LEAPFROG, The New Revolution for Women Entrepreneurs, and it is really a collection of 50 hacks to help women and really anyone else who's currently shut out of the system, really to help them circumvent some of what is currently the status quo and to thrive and grow businesses. My entire adult life, I read business books that didn't seem to be written with me in mind. And so the inspiration for me for writing the book was to once and for all write a book that really is representative of the experience of most entrepreneurs, such as people who don't have friends and family who can write hundreds of thousands of dollars worth of checks to invest in their first round of financing, and all of these things that I thought were uniquely my experience that turned out really to be the experience of most entrepreneurs. Despite the press and the attention that investing in women has gotten in the last few years, the data actually suggests that women are getting less venture capital and generally business investing than in previous years. But it's a missed opportunity. Women are starting more businesses than men in the United States, and in fact, 8 out of every 10 of those businesses is started by a woman of color. So this is the single most entrepreneurial community in this country, which by design means that some of the best ideas and some of the best businesses are going to be coming out of this community. And so while we are investing less in women-owned businesses, certainly than we should, it's an amazing opportunity for upside, and most investors should actually be doing more in the space. When I was getting started as an engineer, we were trending towards getting close to 40% of engineering students being women. And where we are today, unfortunately, is about half as many women are graduating with degrees in engineering. On the surface, that bodes poorly for women-led tech companies, but I would argue that while we recover and while we encourage more and more women to go into engineering, which we should do, the interim solution is to get over this idea that you have to be an engineer or a technologist to start a tech company. Founder who I love, who started a company called General Assembly, talks about referring to companies as being tech-enabled as a ludicrous thing to do. It's kind of like saying my restaurant comes equipped with plumbing. Of course your company comes equipped with tech. Everything we touches or is influenced by tech. And so you don't have to be an engineer to start a tech company. And I want more and more women to realize that and to not allow the lack of that technical degree to keep them from making the jump and starting a technology company. The advice that I would give to women starting their own businesses is that there are a lot of things working against them at the moment, certainly. And we can focus on the lack of capital, we can focus on the various different aspects of the business ecosystem that are not supportive, but there are a couple of really important highlights. For example, women tend to be disproportionately successful at raising crowdfunding campaigns. And so we're already successful in that space. Let's double down. Let's do more of that. Let's build relationships with small business loan officers, maybe at smaller banks that are more likely to put money into community businesses and certainly women-owned businesses. And so let's find the different cracks in the system that already exist. Let's not work in silos. I think that a lot of the times entrepreneurs generally, but especially women entrepreneurs, will work in silos. They have families to raise, they have a lot of other things that they're balancing together with their businesses, and it can be overwhelming to, on top of everything else, network. But that networking and those support systems that you build with other founders actually might be the difference between success or failure. So I would say that those alliances and building those relationships within the entrepreneurship ecosystem are really key. The 2 projects that I'm most excited about one is actually a new fund that's called Full Cycle. And it's a great idea and platform because it really focuses on climate change, which is something that people often don't connect with gender, and I see the two being inextricably connected. In fact, the research shows very clearly that the best way to combat climate change is to actually invest in women, whether it be reproductive health or education of women and girls. And Full Cycle is a fund that essentially invests in companies that can prove that they are offsetting a minimum of like a gigaton, for example, of carbon from the atmosphere. And so it's a platform that focuses on companies that can absolutely prove without a shadow of a doubt that they're reversing climate change. And that's probably the most exciting project that I'm working on. The other one is related but separate, and it's a company that hopefully, if all goes well, will be succeeding at taking the birth control pill for the first time in history over the counter. VCs are investing in the e-commerce space in every possible direction that you could imagine, but the areas that excite me the most are the ones that are really not focused on incremental change, where here's a way to manage supply chain, or here's a way to manage databases, and we're gonna make it a tiny bit more efficient, right? There are definitely people who invest in incremental improvements. The things that I find the most interesting are the ones that are really about building an entire new platform. Think about the early days before an Etsy existed, right? This idea of taking the average handy citizen and giving mostly her an opportunity to commercialize, something that was otherwise maybe a hobby, was revolutionary. And it's platforms like that that are reimagining existing talent, or that are creating a market where there wasn't one. Those platform plays are the ones that are the most exciting, and the ones that I think smart VCs are backing. In terms of what's next for venture capital, I would be a little bit of a contrarian and say what's next for venture capital is not venture capital. I think that with the popularity of shows like Shark Tank or The Profit, it's a little bit like the house flipping shows, where now when you ask somebody to tell you what is real estate, a lot of people would say house flipping. But of course, real estate is a lot bigger than that. And the same thing is true for investing. There are many different kinds of investing, and VC is only one flavor. And it's a flavor that, because of the popularity in the media, has seemingly taken over our perception of what investing is. But I think that venture capital has a couple of really key flaws, and one of them is that it's incredibly short-term oriented. And if you're a founder and you're not trying to build a business that you want to sell within 3 to 5 years, but you actually want to build a forever business, a business like Coca-Cola, a business like Procter & Gamble, the kind of businesses that investors like Warren Buffett have invested in and done really well with, then venture capital might not actually be right for you. Because if you're building a forever business and you care about your employees and you want to be sure that this business exists in 10, 15, 20, 50 years, then there may be other forms of investment, long view investments, that don't really mesh well with venture capital, that might be, in my opinion, more of what we're going to see in the future. Specifically e-tail entrepreneurs, and e-tail entrepreneurs that are thinking that they might need venture capital. I would question whether that's actually true, right? One of the benefits of being an e-tail entrepreneur is that, unlike a brick and mortar business, there isn't as much capital up front that you have to put forward in order to build your company. It's not to say that it's not capital intensive, but it's less capital intensive than a brick and mortar business. And so what that tells me is that you can actually take your business further with less capital, maybe in the first year, 2, 3 years, which means that you can delay as much as possible the opportunity to bring in an equity capital investment. Because what people often don't realize is that when you are getting venture capital into your company, you're giving away a piece of your company, which means you're giving away control of your company, which means that down the line, eventually you may lose control of managing your own company. It is not unusual to see founders fired from their own companies once the board is now taken over by the investors who own the majority of it. And so as you bring on investments, as exciting as it is to have an investor take an interest in your company, question whether it's really the right time. Question whether you can't wait a little longer and retain control of your company. further down that path as you grow it. In the dilemma of whether customers are loyal to brand or price, I would actually argue that customers are loyal to neither. I think customers are loyal to the things that make their lives sustainable, happy, easy. So they're loyal to ideas, they're loyal to their beliefs, and if a brand betrays those beliefs, then that brand is a brand that I as a consumer might not be loyal to. If price is right, I may compromise on my values out of necessity. We have to remember that a lot of people make decisions based on necessity. They might want to boycott Walmart, but if the lowest prices are in Walmart and I'm living on a limited budget, values or not, that might just be a boycott that I can't participate in, right? And so I think that depending on your circumstances, you're loyal to different things, but fundamentally, if you are a family that's working on a limited budget and you are directly impacted by the recent mass shooting at a Walmart, you might actually find a way, as inconvenient as it might be, to actually participate in that boycott. And so I think that fundamentally consumers are more and more loyal to their belief system. And whether it's pricing or branding, I think that companies have to figure out how to stand for something. And sometimes that can be difficult because when you stand for something, you alienate people who don't agree with you. And as a business, that can really be a difficult decision to make. But I think consumers increasingly are expecting that from their brands and from their companies. When you're new to a market, customer acquisition costs can be low because you're innovative and nobody's ever heard of what you're doing. Once you get copycats and once a market starts to get saturated with a lot of competitors, then customer acquisition goes up, of course. And there's not a lot that you can do to bring that price down, but I would argue that the idea of connecting organically with your customers, of making these difficult decisions like standing for something, right? Maybe making headlines because you made that decision. That is a way of getting earned media that costs a lot less than a PR firm and a marketing agency. And it is allowing you to build a level of loyalty that's authentic. It doesn't happen overnight. It takes time. Customers are intelligent. They know when you're just giving something lip service and you're not actually authentic in that belief. But if you stick with it, and if you show your consumers that you believe in something, that you stand for something, and that you're in it for the long haul, what will happen over time is that not only will you build loyalty, you will reduce the cost of customer acquisition.